Okay, this is a quick presentation given by Plotus Assets for new traders who have trouble understanding all about the 5-minute trading strategy that we do during the Asian Open. So step one really is to prepare. You want your indicators open so you can see them, and you should know what these are by following on in the group. So of course you've got those two indicators, and secondly you want to be able to trade. So you want to have your stock pair account open and set to 5 minutes, of course, so that in the heat of the moment you don't end up putting a trade for 2 hours or an hour, and set your stake to something low risk such as £20 if you're trading a 500 account. Really you want to keep it to 2%. Of course 20 of 500 is not 2%, but if you have a small account there's not much you can do. But if you have 1,000, ideally the right trading risk is £20 for that. Okay, so step 2, what you need to do is open up the full windows of the assets we're concentrating on. That is the Euro USD, AUD USD, USD JAPY and GBP USD. What you need to do is, after you've opened all the windows, go to each window and confirm that they're all set on the 1 minute time frame candle. This is very important because this is a fast moving binary options trading strategy, and it needs the 1 minute time frame on MetaTrader, but of course in your stock pair you set it as 5 minutes. So if the indicators are correctly installed, you should be able to see something similar to the following. So here we have a chart. This is the Forex breakthrough chart. So you've got here, if you follow my mouse, the red lines. This is the resistance line. You've got the first resistance line and the second resistance line. And if you look at the lines at the bottom, you've got your support lines. This, of course, is the price action. Here at the bottom, you've got your stochastics. These settings are at 853. So when you load the stochastics into the chart, do please make sure that it's set at 8, 5, and 3. You can change it by double clicking it and simply editing it like so. So this is the first indicator, of course. Let's switch over to the 5 minutes. This is your second indicator to look at the first. You've got all of these lovely gizmos here. Okay, so here is the main thing that we look at, is the trend percentage. So up right now is 40% and downtrend is about 60%. So overall we'll say the downtrend is winning. And of course if we go to the original, just 1 second, I've set mine as the default. Then you can see that this is kind of looking a bit like an uptrend. So these two indicators we would say are not confirming each other. So it's a mixed signal. We wouldn't really take a trade at this point. Okay, so let me show you some examples of trades. Okay, so you can see suddenly as the USD JPY has hit the upper resistance level, this is clearly an uptrend. Now surprisingly the price has come plummeting down and hit the support level. And this is almost a perfect entry because the stochastics here is around 4%, which is under the 20% threshold needed to confirm. So this would be a good point to take a buy signal. Let's see how it gets on. Okay, so that's 5 minutes into it. You can see this is where the position was taken. 1, 2, 3, 4, 5, and we're well into the money. So if you made that trade, it was a textbook trade and you would have been in the money. So as we have mentioned, a buy signal is when the trend is going up, the red and green lines are gradually rising as shown, and the stochastics are less than 20%, and the price hits the support, and we just double up and confirm that the trend percentage is more up than down. Then we go ahead and we take our buy signal. Okay, a possible trade may be coming up now. Okay, that last one was way too high, and you can see it hit the second resistance point, but the stochastics is 98%, so this is the exact opposite of what we had last time, and we'd be looking to sell the USD JPY. Bear in mind though, this is slightly different to before, because you might say this isn't a downtrend. Well, our definition of uptrend or downtrend really is in the short term. So for example here, you'll see the red and green lines are going up as if to show an uptrend, but then it bends all the way down and it's showing a downtrend. So you only look within the last 5 to 10 minutes to see. So sometimes you can even get situations where it's looking down, but at the last minute it's curving up. In those cases you don't risk it. But this clearly is a downtrend and a high stochastics over here, 98%, and the second resistance level here. So the price action is really going to be exhausted here, and you'd expect the sellers to jump in and push the price back down. Let's see if that's the case. And here we are. 1 minute, 2 minute, 3 minute, 4 minute, 5 minute, 6 minutes. So clearly our price would have expired somewhere down here, and the trade would have been yet another win. This really is a simple strategy, and if you just stick to the rules, you can end up doing very well. Let's also have a look in the other template. So let's go to 5-minute blooters. You can see clearly here, and this is very important to remember, the downtrend here is 79%. So that was a further signal to us when we took the down trade. So in the presentation, as you'll see following, you always use this as a way of confirming whether you should continue with the trade or stay out of it. So you see the red and green lines are descending, the stochastics are more than 80%, showing some exhaustion in going up, and so it's hit the extreme of 80% plus, 90%, and it wants to come back down. We wait for the price to hit the resistance, and we confirm that the trend percentage is more than 75% down. Now, we don't always have to do step 4, but it is advisable to flank out some false signals. So just briefly on hedging, of course not every trade is going to win. So when you make a losing trade, it's not all bad. What you can do is you can increase your next stake so that the win on that actually covers the loss of your previous stake. So for example, if you traded 20 and you lose it, well, you're down 20. So if you just trade 20 again on your next trade, you're not actually going to break even because of the slight discrepancy between your win return and your lose outgoing. So you increase your stake by 150%, so $20 becomes $30, and that helps you to not only break even but actually give you a little bit of profit as well. Now I will stress that you do not keep repeating this for losing trades. The reason is it's just basic mathematics really. Something like a 70 to 80% win ratio is considered extremely brilliant in binary options. You're going to make a lot of profit if you're getting an 80%. But if you actually think what 80% actually is in terms of statistics, if you consider 80% of 1,000 trades means that 20% of the time you've got losses. So 20% of 1,000 is 200. So if you imagine, there's nothing stopping those 200 losing trades coming all at once. It's very unlikely, but you could have, I don't know, 200 losing trades and then 800 in a row winning trades. It just really depends how the distribution goes. So in order to protect yourself, hedging is only done when you've got a really good signal to hedge the other one. Otherwise, just accept your loss. It's not a problem. Generally, we don't hedge more than once, but there are exceptions. This comes with experience, and as you'll see on the group, everything is discussed, and so you can look forward to learning all of that good stuff. I do hope this has been insightful and a little bit of help. Of course, if you need any more assistance, do get hold of me on plotosassets.com, or what you can do is add me on Skype. That's Skype ID Plotos Assets as well, and I'll be happy to help.